everyone, it's Alissa Coram here, and today I want to talk to you about FOMO. When you see the market surging higher or notable stocks roaring, it can be tough to fight that FOMO, the fear of missing out. But luckily, I'm here to share 3 trading hacks that I've learned from the pros that can help you fight FOMO when you feel it creeping in, so that way you can stay healthy mentally and your portfolio can stay healthy too. As investors, there are many times we are faced with FOMO, whether it's the hope of a new strong market rally after a big correction, big name stocks shooting higher on earnings or another news-driven event, or holding on to a once leading stock that's taken a big hit in the hopes that it'll turn back around. But if you acted on that emotion, that rules be darned urge to do something every time that you felt it, odds are you and your portfolio would be worse off. That's because trading based on your emotions instead of rules leads to poor decision making. Whether it's buying, selling, or market-induced FOMO, here are a few trading hacks that I've learned that can help you whenever you start feeling like your emotions are getting the best of you. So first, the market. After a big correction, a new rally will eventually begin, but this is a period of uncertainty. Market bottoms are not straightforward, and I think you'd be hard-pressed to find someone who has a good track record of exactly calling bottoms every single time. But when stocks have taken big hits, investors may be tempted to get in there and buy stocks at a cheaper price before the market's next move higher. But truth be told, that's pretty risky. Even if you do see some encouraging signs that the market has found its footing, that does not mean you should be going all in. But that temptation is there, that fear of missing out on the very beginning of a new market rally. So the hack here has several components. Think short term, be selective, and go with a smaller position size. Now let me break all of that down. During a correction, you should be mostly in cash to protect your capital. But if you feel like you have to buy something, put on your short-term trader hat. In corrections and other periods of heightened volatility, you need to be able to get in and out very quickly in order to profit. That means locking in gains fast, being flexible, and only adding exposure when the market proves itself to you by the overall rally strengthening and leading stocks continuing to improve and set up in proper chart patterns. You also need to be selective. During a market correction, if there's broad-based damage, you don't just want to be buying anything and everything that's moving sharply off lows. We call that bottom fishing, and that's not a sustainable strategy. Our research shows that there are those former leaders that take big hits during a correction that may never come back. So if you're not seeing high quality stocks with strong entry points like a retake or a reversal off of the 50-day line, then perhaps consider an index tracking ETF for one of these short-term trades. This is something that I learned from IBD's Chris Gessel and Justin Nielsen. Now, by going the ETF route, whether that's QLD or TQQQ, which are 2 and 3 times the performance of the NASDAQ 100, or SSO or UPRO, which are 2 and 3 times the performance of the S&P 500, this strategy allows you to take advantage of a turn in the market without having to pick an individual winner. This is especially helpful if you're not seeing that strength underneath the surface. But if trading leveraged ETFs is new to you, be very careful because these things can really move against you very quickly if your timing is off. And the third part of the hack here is to go with a smaller position size. In healthy markets, investors looking to generate outperformance may go with 10 stocks at 10% weightings each in their portfolios. During a correction or other periods of heightened volatility, it's a good idea to go in with a smaller position size since investing during these periods carries heightened risk. Now, a smaller position size would be considered 2% or 3% of your portfolio. And as always, ideally, you never want to take more than an 8% loss on a trade because risk management is absolutely key. I also want to note that this strategy assumes you know a little something about reversals and other key technical levels to watch from a swing trading perspective. Now, second, there's another type of FOMO that happens when it comes to buying stocks. Say there's a stock that's making a really nice move, but for whatever reason, when it was in a proper buy area, you missed it. And now it's extended. When you buy an extended stock, you're leaving yourself more vulnerable to getting shaken out of the trade in a normal pullback. But if there's a stock that you're just so jealous of the move that it's making and you feel like you're really missing out, then you can go with what we call a mental health buy. Now, this is a trading hack that I learned from David Ryan, longtime portfolio manager under IBD founder Bill O'Neill and a noted investing expert. He says in these instances, you can make one of these mental health buys, an improper buy, to make sure that you're not having all this regret about missing out on a great trade and watching one of the market's next big winners go up without you. I used the mental health buy strategy with NVIDIA in 2021. Now, in May of that year, NVIDIA announced a stock split and rallied on that news into earnings. It then delivered a strong earnings report with accelerating growth on both the top and bottom lines. A few days later, it broke out of a cut base. And at that time, I did not pull the trigger because I saw NVIDIA going sideways for the prior 9 months. But when that breakout continued to pick up steam, it was at that time that I decided to go with the mental health buy, which I like to call the FOMO buy. But whatever you call it, mental health buy or FOMO buy, you want to make sure that it's a stock of quality. A true market leader that's not only exhibiting technical strength, but a game-changing company with super strong fundamentals. You also want to go with that smaller position size like we talked about earlier with these mental health buys. Since buying a stock extended carries added risk, you could be caught in a downdraft. Stocks don't always go straight up, so this allows you to participate without that same level of dollar risk as you would with a full position. Once you have the mental health buy, look for proper areas on the chart to build up that position. And if the trade turns against you, well, you weren't risking that much. But just make sure you have that line in the sand, that level at which you know that you're going to be getting out of the trade. Which leads me to the last FOMO situation that I want to discuss, and that's selling. Okay, so I want to use Upstart for this example, which had just an absolutely epic run in 2021. I'm sure many of you remember. A 26% gap up on earnings in August led to a phenomenal run. The stock went from 135 to about 400 in about 2 months. During that time period, many investors, no surprise, got all the hard eyes for the stock, the company, and what its AI lending software was doing to shake up the landscape. So when the stock gapped down 18% on the next quarterly report, many investors used that story, the numbers out of the quarterly report, and the company's guidance as their basis for holding on to their shares. Fast forward a few months, and the stock dropped below the $100 mark. Traders who held on to their shares for that entire move up and back down, or just caught the down part, definitely had FOMO if they didn't sell. There was a fear that they were going to miss out if the stock just turned right back around without them because that story was so compelling. So here's a hack that IBD's Scott St. Clair taught me. And that is to just sell a few shares. If you feel like the stock is going to turn around and move higher, then just sell 5 shares. And if it heads higher, then you only sold a small part of your position. But if it heads lower, sell a few shares and a few shares more until you get yourself out of the trade. Live to fight another day. Don't buy or hold stocks that are in downtrends. Reserve that FOMO for stocks that are of quality. It was IBD founder Bill O'Neill himself who said there's only one type of good stock, and that's one that's going up. So I know this was like 3 videos in one, but I hope those details were helpful for you in times that you're facing FOMO. I really want to know in the comments about a time that you faced FOMO in the past and what lesson you learned from that. And be sure you subscribe to my channel because I have a lot more trading hacks and money tips to come. Thanks so much for watching.